It's a new month here at Henssler Financial, and we found 3 important things to focus on in the market this month. Number 1, the FOMC meeting. As inflation continues to run at multi-decade highs, the Federal Open Market Committee will once again make a decision not whether or not to raise rates, as it's a foregone conclusion that they will, but the question remains by how much. The Fed is set to meet again on June 15th, and markets are currently pricing in a 95% chance of another 50 basis point rate hike, which would put the federal funds target rate between 1.25 and 1.5%, just 25 basis points below where it was before the governing body slammed rates to zero amidst the COVID-19 pandemic. The Fed is also expected to stick to its previously disclosed plan to allow up to $30 billion in Treasury securities and $17.5 billion in agency mortgage-backed securities to mature and roll off its balance sheet per month starting in June. Finally, investors will be watching closely for any potential changes to the Fed's long-term inflation projections. Previously, Fed guidance suggested that the Personal Consumption Expenditures Price Index, or PCE, the Fed's preferred inflation measure, would be 4.3% in 2022 and fall to just 2.7% in 2023 as inflation subsides. However, market participants don't have the most faith in the Fed's inflation projections, given how not transitory inflation has been post-COVID-19. Number 2, the health of the consumer. Recent data and commentary from CEOs is raising red flags and suggesting that the stimulus-driven strength of the U.S. consumer may be fading. Last week, JP Morgan CEO Jamie Dimon suggested that the U.S. consumer has roughly 6 to 9 months of spending power left in their bank accounts and warned of an economic hurricane brewing. April data showed that U.S. consumers continued to boost spending for a 4th consecutive month. However, the savings rate fell to its lowest level in 14 years. Recent announcements from retailers seem to suggest a slowdown as well. Look no further than 3 of the nation's largest retailers, Amazon, Walmart, and Target, all of which have noted a slowing consumer just as these companies have built up inventories. The latest consumer credit data also suggests that the U.S. consumer is once again relying on charging purchases, further suggesting household balance sheets may be weakening. Total consumer credit rose $38.1 billion to a record $4.57 trillion in April, well ahead of the $35 billion gain expected. This is the 3rd straight month of gains in consumer borrowing above $30 billion. Revolving credit, like credit cards, rose at a 19.6% rate in April to a record $1.1 trillion. While this could be a function of high inflation and could prove to be temporary, it could also be just one more sign that consumers are facing difficult times ahead. Number 3, will the tech wreck continue? The darling tech stocks of 2020 and 2021 are off to their worst start in more than a decade, with many suggesting the sell-off is reminiscent of the dot-com bust of 2000. Year-to-date through May 30th, tech stocks lost 19.39%, the worst start to a year for the sector since 2002. Growth stocks have dominated value stocks for the better part of a decade, but that tide appears to be turning as inflation runs hot and the Fed is tightening at a pace not seen in many years. Higher rates, which make the future cash flows of companies less attractive, are likely to persist and could mean continued pressure on these growth-oriented tech stocks. Despite the sell-off, tech stocks still account for a near-record 27% of the S&P 500, hovering near the highest level since the dot-com bubble. Many are now asking if it's time to dip their toe and buy these stocks on the sell-off. If this is the deflating of a bubble, we caution to remember that typically when bubbles break, they don't just tend to fall back to the average valuation. More often than not, they have to fall to the other side, suggesting more pain could be ahead. Currently, the price-to-earnings ratio of the S&P 500 technology sector stands at roughly 26 times. This is well above the average of 22 times for the last 10 years and 23 times since 2003. And that's been your Market Minute for the month of June. Thanks for listening.